Hello everyone, welcome to a new video. Today I would like to share with you and analyze one stock that I have in my portfolio and that I actually bought at a pretty good time right on the crash of March 2020. Also, it is a stock that I have not seen many analyses done on YouTube, and this stock is TransAlta Corporation. But this video is not really about when did I buy in the stock market and so on, but about the future perspective of the company and what do I think of it. So mainly I will try to do an in-depth analysis on this company in particular by summarizing all the information that you can find out there of it, and to hopefully help you decide on whether this might be a good investment opportunity for you or not. And by the way, I just want to remind you that I'm not a financial advisor of any kind and that I'm just sharing here my thoughts on the company and what I analyzed when I decided to buy in it. And by the way, if you haven't seen the video, I recently published one in which I explained the things that I check when analyzing a stock, which is basically what we will be doing here today with TransAlta Corp. So if you're interested, I will just leave it above here for you. First of all, the company was founded in 1911, so super long time ago, and it is listed in both the Stock Exchange of Toronto and New York, in New York under the ticker symbol TAC, so TAC. At the moment of recording this video, it is trading at roughly $6 per share, but nevertheless, let's go and actually analyze the fundamentals of this company and the stock. It is one of Canada's largest power producing companies, and actually it's not only located in Canada, but they also have power plants in the US and in Australia, which means that they are a bit diversified. And what they do is they don't only produce the electricity, but they also sell it to the final customers, whether these are individuals or companies. The way they produce their energy is through coal, natural gas, wind, water, and sun energy. They are actually transitioning to being a more renewable energy company, and in fact, they are the largest producer of wind energy in Canada. But now let's look exactly at how much of their revenue is coming from each of the power sources that they have mentioned in order to see how renewable they are. Based on this first Q1 2020 earnings report, I elaborated a table with how much of their different EBITDA, so earnings before taxes, interest, amortization and depreciation, came from the different segments. We see that renewable energy is only renewable, because natural gas sometimes it's considered renewable, but to me it's not. They produce 42.3% of their total revenue, which to me is quite surprising and positively speaking. But we cannot forget about the fact that still 57.63% of their revenue is coming from coal and natural gas. Theoretically, by 2025, they will no longer have any more coal plants and they will have fully transitioned to only natural gas and renewable energies. And in fact, the last year investments that the company has done clearly prove this, that they are really transitioning to being a more renewable energy company. As you can see in the screen, they have mostly invested in wind, but also some solar producing plants. From my eyes, it is really good because it means that they don't only say it, but they are actually also doing it. Moreover, another important point to consider in terms of renewables is that they are also the majority owner of their sister company, TransAlta Renewables, which is only focused on renewable energies and natural gas. So when investing in TransAlta Corporation, you are partly also investing in their sister company, TransAlta Renewables, which is, as I said, only focused on renewables and natural gas. Now let's look at something super important for me, which is the dividend yield. As you know, if you have seen other videos, I'm a dividend investor. So in the case of TransAlta Corp, they have, at the moment, they are trading at $6 per share. So at this price, their dividend yield is roughly 2.12% with a payout ratio of 13.47%, which means that their dividend is really safe. And to be fair, the dividend is not very high, but they are gradually increasing it, and actually they have a lot of room for it, seeing this payout ratio. And actually at the price I bought in, I am getting roughly a 3%, which is more in line with all the rest of stocks I own. The next thing I check is the balance sheet, and more concretely the debt ratio. In this case, we see that the company has a debt ratio of only 57%, which means that according to my metrics, it is a low-risk company. And this is specifically important in the times that we are living. In terms of income statements, the company has not been doing specifically good, and this has also made its price in the stock market plunge significantly. During 2017 and 2018, it had important losses. Nevertheless, I think that it's also important to acknowledge that during this past year, 2019, they were profitable again with the 52 millions in net profit. So hopefully it is back on track for the next years to come. And to me, it is a pretty interesting company because if they manage to be profitable and remain profitable for the next years to come, they are in a very good position. If we look at the stock price, we see that the company has faced much better times, but it's also when the stocks are trading like this that the best investment opportunities come in, of course, if they manage to stay on the right track. But analyzing it overall, as I already mentioned, I think that the company is interesting. And the reasons for it are the following. First of all, it is in an industry with very high barriers to entry because, of course, the initial costs of building power plants are extremely high. Moreover, it is very well positioned when it comes to renewable energies. As we have seen, they are the largest wind producer of energy in Canada, and also based on their actions that they have taken during these past years, they really show that they have a clear focus on renewable energies. Also, we need to notice that the stock price at the moment is pretty low, historically speaking. So in my opinion, if the company is able to remain profitable during the next years to come, it can get the attention back from investors, especially considering the renewables section. And if it gets the attention back from investors, it means that it has the opportunity for growth and also to increase dividends because, as we saw as well, they have a pretty low payout ratio. Finally, it is a company committed to investors. On May 26, 2020, it announced that its shares repurchase program had been approved again. It is nothing new, but it continues in line with what they had been doing these past years. And it basically means that they buy shares of their own company and they delist them from the stock market. More concretely, they have been allowed to do so for one more year for a total of an extra 14 million common shares, which represents a 7.02% of the total public shares that they have trading at the moment. These buyback programs are very interesting from an investor's perspective because it means that the company is seeing their shares usually trading at low price and they are buying those shares, and then maybe in the future as the stock price increases, they can reissue those shares and make profit as well out of that. Moreover, there are also beneficial things for the company, such as the fact that the dividend payout is reduced because, of course, they have less shares in circulation, which means that they have to pay less dividends to investors, and this also translates into having a better balance sheet. So personally speaking, as I already mentioned, I bought some shares of this company back in March 2020 at a buying price of $3.85 per share. So far, from when I bought in, they have increased already in 50%, and I think that from a future perspective, as I said, if they manage to remain profitable as well for the next years to come, the stock price can increase and also the dividends that they pay. And what will I do next? Well, if the market drops again, then I might buy some more shares. Maybe if they get to $4.5 a share, $4 a share, I might start to get interested again, especially because, as I mentioned in the other videos, I look for dividend yields of at least 3%. So that was the end of the analysis of this stock of TransAlta Corporation. I tried to put in all the information I found out there and so on. So now I leave it up to you to decide whether this is a good investment and to make your own research on that. As always, thank you very much for watching to this video. If you enjoyed it, make sure to like it, subscribe, and see you next time.